All right, we got a hot one for you today. We're going to be talking about how in the world do you distribute your wealth with a $10,000 portfolio. How would I recommend dispersing your money in order to get the best possible return? So this is just my opinion, obviously, but we're going to go right into it. Start with the largest portion, being 30% of your portfolio. Big portion. I'm going to give to growth. Right? Okay. Ooh, good W there. Growth. Growth stocks being companies that are growing rapidly, that should be able to give you rapid capital appreciation. Now, the main part of this that you need to consider, obviously with these growth portfolios, they are usually companies you have to rotate every 2 to 3 years. You know, it's not necessarily you're going to be holding the same company for 20 years in that case, because these growth stocks usually tend to simmer down, and you'll rotate in new ones that are, top of the edge market. So that is what I would suggest. So right now, growth is kind of headlined by technology or tech stocks. So a lot of it's probably going to be tech stocks like your Facebooks, your Apples. That's going to be making up a good portion of this 30%. But that is my opinion on the first 30. The next biggest chunk, which, guess what? It's also 30%. You wouldn't believe it. I duped you. That's the worst percent sign ever. I'm going to give this one to dividend growth. So dividend growth. And dividend growth, in my opinion, you're going to want to look for stocks that have grown their dividends a minimum of 5 years. It'd be ideal if you get companies that are in between like the 10 and 20 year range in terms of dividend growth. That's where you can assure the most value in that. Certainly always exciting to see some dividend growth. And if you are going to choose a company that isn't growing dividends, I think it's perfectly fine to throw in here companies that have a consistent dividend, at least if they haven't decreased dividend. That's what you care about. Because I know there's a couple companies that have paid the same exact dividend throughout history, and their yield's been consistently somewhere around 3%, right? I would aim for a yield somewhere around upwards of 3% for this portion of your portfolio. Next portion here is going to be 15%, and I'm going to give that to real estate investment trusts, REITs. Why would I do this? Well, I think it's important to have a portion of your wealth in real estate for sure. This is a way to do it without actually investing in actual real estate. It is certainly a way you can do it. Something to consider, absolutely. And usually you get a very decently high dividend yield on these, and they're companies that pay dividends consistently, and they're usually dividend growth companies as well, but they're their own sector, and it's worth mentioning them. I usually do this to boost the dividend yield of my portfolio. Next, I'm going to say 15%. Again, that's a good 15. 15% to ETFs. Now, this can be ETFs of your choice, ETFs being electronically traded funds. So these are going to be like mutual funds where it's someone is managing these collection of stocks that they hold. There are countless out there from every different investment group out there. Some of them focus on dividends, some of them focus on growth, some of them focused on any sector you could imagine. But 15% of your portfolio, I think, is beneficial to have in electronically traded funds. Usually just as a good rock to that portfolio. It's pretty steady, even if you have ones that just follow the markets, follow the S&P 500, follow NASDAQ. You could have those, and that'll just track the market pretty well, and it's a good base for you to have, so that way you don't have anything too crazy going on, and you have a chance for just consistent market growth as well. Next, I'm going to put 5% in, it's lame, bonds. 5% in lame bonds. James included. What other kind of bonds? Barry. All these bonds. No, I would put it in bonds, right? So this is just something that pretty steady. You don't gain really capital appreciation from it. You really only gain the dividend from it over time. So that's why bonds are pretty nice. Again, it's just like a consistent capital to have there that just earns you money off of your investment, and it's not going to sway the value of the portfolio too highly. So let's finally, my last portion is 5%, and it's a little high, I know, but that's right, 5% spec stocks, speculative stocks. These are things that could, 10 times value, 50 times value, 100 times value. Not necessarily penny stocks, let's not get into that, but these are companies that are not necessarily proven, and there's not necessarily proof of them being super successful, but there's the chance. As long as you do the research, you need to have great research done on these speculative stocks. There's a chance this 5% here could be a big winner for you. So obviously it involves not just picking random stocks that are cheap that you don't know anything about. You have to do a lot of research with them. And if you believe it's something that could be viable, that could skyrocket in time, that's what this portion of your portfolio is for. Obviously, you can't expect to have a bunch of winners, and that is why it's only 5%. It should be a minor part of it, just that way it doesn't sway the overall value too much. That's my opinion on the matter, at least. I don't think you want to have spec stocks taking up that hefty of a portion. But again, it could be a big gain in case you do your research and things work out for you. But again, it's all speculation. That's why it's spec stocks. So off of this too, I think it's important to mention, I think you're going to want a minimum of a 3% yield in terms of dividend. So you want to get 3% back on your money regardless of how the market does. That's my opinion on the matter. I think you want to aim through all of these. Obviously, some of these growth tech companies can pay dividends, like Apple pays a dividend, if you think about that. It's not 3%, but it adds to the whole shebang, It adds to the shebang. I never thought I'd say that in my life. But you want to average at least a 3% yield. The way I have it set up here, I think my portfolios tend to average a little bit above that 3% mark, somewhere around 4% actually. And that's what this setup kind of will get you, especially with these 15% real estate investment trusts and 30% dividend growth. A lot of people tend to weigh a lot heavier on the just growth side, and that's perfectly fine for capital appreciation's sake, but again, we'll see. Now I'm going to really quickly pull up the good old calculadora, everyone's favorite calculadora, shrink it down to size for you. So this is a $10,000 investment, right? So this is going to be without putting any money in, right? I'm considering this, you just put $10,000 in and you let it sit there. And I'm going to do an annualized return of 7% plus our 3% yield. So I'm saying you're making 10% on your investment every year. We're just going to do a calculation because a lot of people don't think about it. And this is just proof that the earlier you invest, the better. So we're going to do this 10,000 times, not that. So 10,000 times, oh my gosh, never mind. Forget that. We're going to open up the calculator blank. It's being dumb. Calculator. Give me the calculator. Give me 10,000 times 1.1. So after 1 year, look at that. After 1 year, you have $11,000. Right? And that's just reinvesting your dividends and adding that 7% average yield. Or average gain per year in the market, because that's annualized over 20 years. That's usually around what you get. So that's 1 year. 2 years up to 12,000. Okay. You see what's going on here? A lot of this, let's go 3 years, 13,300. This is what's referred to as compounding, right? The more money you have, the more that percentage gets you. So now you have a $13,300 portfolio. After 4 years, 14,600. Okay, 5 years now, 16,000. So you're already significantly increasing what you're getting there, as opposed to where you started off the first year only getting 1,000. This most recent year, you just went ahead and put up a 1,400 improvement. Quite nice. That's after 5 years. So we're going to go ahead. I'll do this through, let's say we'll give it 30 years and just see how it goes. So let's say you start investing when you're 30 and you retire when you're 60. Why not? And that's when you sell your portfolio off. So we're at 5 years, 6 years, 7, 8, 9, 10, 11, 12, 13. This is Count Chocula here. 14, 15, 16, 17, 18, 19. I love all those decimals. 20, 21, 22, 23, 24, 25. Ooh, 26, 27, 28, 29, 30. Okay. So this is putting literally no money in besides that 10,000 that you put in. Which, I mean, not everyone's going to do. I mean, I wouldn't suggest just putting in a lump sum and letting it sit there forever. You should always steadily add. But in case you wanted to do that experiment, an annualized 10% gain, if we're looking both with dividend yield included and you're reinvesting that dividend, in 30 years, you've made that $174,500, right? $10,000 turned into $174,000 after 30 years. That's a hefty chunk of change without putting any more money in besides that initial amount. So if you consider putting in any more money per year, just think about where that could put you. You know what I mean? If you ended up putting away, which it's a hefty amount, $10,000 extra. I mean, you'd get exponentially more money off of it. And any more money on top, just think about it. It's because it's exponential growth, if you think about it. Because you're doing that multiplication, it's exponential growth down the line. The more money you have in that account, the more that 10% actually means to you down the road. So now we're going to go ahead and just for fun, you started investing when you're 20, and guess what? You're going to go ahead and retire at 70. So it is 50 years out. So 31, 32, 33, 34, 35, 36, 37, 38, 39, 40, 41, 42, 43, 44, 45, 46, 47, 48, 49, 50. That's right. So let's just say you're 20 years old and you've collected birthday money, whatever it is. Your family had a school fund. I mean, there could be a college fund out there, you think, but you went ahead and you know what? You rocked it. You rocked it. You got a full ride scholarship somewhere. They were going to put $10,000 towards your education, but no. You got a full ride scholarship, so you get the $10,000 outright and you put it in an investment account. You literally just let it sit there. Just sit there with getting 10% every year. You are a millionaire by the time you're age 70. Obviously, that doesn't seem like a lot, but it's not like this is all you're earning, right? You'll still be earning money on the sideline, and you can have your own personal brokerage account as well. Is that crazy to anyone else? I mean, millionaire by age 70 after 50 years of just letting $10,000 sit there? I think that's quite crazy, but again, that's why you want to aim to get started early. That's kind of what this point was here. Get started early and invest as early as often and as much as often, because this 1 million could easily be, 10 million if you put in extra money every couple months. Just think about it. Just some food for thought, but that's how I would put together my portfolio here. $10,000 portfolio. There you go. Become a millionaire by 70. Alrighty.